Hello and welcome to Livewire's Fund in Focus. My name is Chris Conway. Today I'm sitting down with Griffin Capital's Ashley Burtenshaw. Ashley is going to be talking to us about the Barings Liquidity Investment Strategy, otherwise known as BLIS. Ash, welcome.
Thank you, Chris. Thank you for having me.
Just to set the scene, Griffin was bought a couple of years ago by global investment manager Barings. How's it been going so far?
Great. It's been a great success, actually. AUM is, nearly doubled from, where we came into Barings in 2023 to where we are today. So that's been fantastic. And then the other good thing about it is, we're now starting to get some international recognition. We're sort of reaching out to the international markets where before, when we were at Griffin Capital, we were purely domestic focused.
Yeah. So we're here to talk about the Barings Liquidity Investment Strategy, BLIS, pretty cool ticker name, so well done on that. It's a relatively new fund, but it's also not new, Ash. So the strategy's been around for a while. Tell us a little bit more about it.
Yeah, the strategy was born out of the institutional market, again back in 2010. And it's been run by the same senior PMs, myself and Stephen Fleming, for 15 and a half years. We've now taken that strategy and, it's been accepted by some other international investors as well.
We've been in a volatile rate environment, Ash, down, up, and then maybe coming back down again now. How do you evaluate and manage credit risk in this sort of environment?
When you think about, credit risk and you talk about volatility, credit risk, as a credit investor, what we do is we sell volatility. So when it's volatile, all we can get is the premium that, on those bonds. So the way that we handle it is we actually bring our spread duration shorter, so therefore we don't actually have as much noise. We actually increase the liquidity in the portfolio in terms of more cash and more bonds that actually, those bonds that are actually focused in terms of get a lot more penetration in dealer market. And then, we look at, bringing down the risk budget. So being, more in AAAs and AAs, less in the sort of, the other parts of the credit curve. I guess we sort of then talk a little bit about that volatility that comes out of rates. What's that going to do with the rating agencies? Are the rating agencies going to start looking at downgrades and upgrades? So, what we will be looking at is those structures that are more fragile. We'll be looking to avoid those and those losers. So that gives you a snapshot what we're dealing with when we get in those volatility times.
Yeah. I want to make sure I get this number right, Ash. 59,000 plus residential mortgage loans in the portfolio. It's a big number. So how do you think about geographic risk and then the distribution of the LVRs?
So when we look at geographic, what we're looking at really is diversification. So we say to our investors, we don't take diversification at the originator or the lender level. We're concentrated there, but we take our diversification at the loan level. So if you think about 59,000 loans, all scattered around the country, if you heat mapped it, it would sort of map to the 2 trillion mortgage system that you brought up earlier today. And then in terms of LTVs, loan to values, clearly, what we're looking for there is those LTVs that have actually got at the higher end and, potentially over 80. And if they are over 80, can we get those LTVs insured, or where's the postcodes do they reside in? Are they in really bad postcodes in terms of worst performing, known for their constant delinquencies, or they're in postcodes where we can get a lot of comfort or confidence around the actual valuation. So 2 seconds flat, that's how we sort of think about the geographic and the LTV distributions.
Yeah. Ash, the holy grail, sustainable income and making sure that you preserve capital as well. How do you balance those competing objectives in BLIS?
Risk has to be controlled, right? So if you think about it, and so because we're controlling risk, then what we actually have to look at is when we're buying these bonds, it sort of has to be an investor mindset where it's held to maturity, right? Or what we call bond heaven. Like, we're never going to get liquidity, but will I get my money back? Is sort of the mindset. Then what we've got to do, once we understand that, what we then got to do is assign, what's the appropriate income, or what's the appropriate spread that we should be earning for that. And then that dovetails into our sort of investment process. And our investment process would be then looking at, okay, well, when we stress the deal, the coverages, from a protection or loss cover multiple in the deal. What is the basis between, the warehouse markets and the public markets? What is the spread between the vanilla credit markets and the risk that we're looking to acquire? So, it really comes down to the investment process, but first and foremost, we actually need to control for our capital.
Ash, I imagine those building blocks feed into consistency and liquidity, which are another two important factors that you focus on. Tell me a little bit more about that.
When I think about consistency and liquidity, I think about you wanting me to be true to label. It is effectively what you're saying. As an investor, if you think about, liquidity in our product called BLIS, they've got daily dealing. So we've actually got to, construct a portfolio that can deal with, that daily dealing, because that's what investors want, and that's what we've said it's on the tin. Mm-hmm. So, consistency, it's all about being focused. If you're focused, this is all what you do, you're then very good at delivering on what you actually say. If you get distracted, that's when you start to become a little bit inconsistent. So what we've done in terms of our investment process is we looked at feedback loops constantly to make sure that when we've entered into these types of deals or bonds that we're looking to buy that's going to deliver on this true to label, that they actually then, set at the investment committee what is the consistent traits that we're doing for our investors.
Ash, talk to me about the advent of the Van Eck RMBS ETF. I know it's not your product, of course, but it finally appears that RMBS and ABS has made it from the high street or Wall Street to Main Street. Why has it taken so long?
I reckon that's a really good question. In answering it, Chris, and I break it down into sort of 4 points. I think time's the best measure of success. So, it's been 17 years since the RMBS market was, the culprit of potentially financial insolvency. Yeah. I think also education. I think there's a number of strategies around, using RMBS, and so, the market's becoming more and more educated. I also think, and I'm plucking here, but maybe the advent of AI. I've done some of the AI and looked at putting it in and RMBS and looking at the outcomes of how they're actually debunking the myth and trying to make it more simple. But also, I think as well, it's maybe the people are reading The Economist or something where they actually wrote this article about housing, the indestructible force, and that type of housing here continues to climb and continues to do well. And so that being the case, I think, we're getting more and more adopters.
Yeah, well, it makes sense here in Australia because Aussies love their property, which I know you would know. So let's round it out, Ash. I want to just talk about product innovation. So the success of your other fund, GCI, 7 years ago, I think it was launched. Now BLIS. Is there any more products on the way? What are you thinking about?
We are thinking of doing something else. It's not something that I can really talk about at the moment, but it sort of sits halfway in between the sort of the liquidity seeking and the return seeking. So it is something that we think has got merit in the marketplace.
Watch this space,
Watch this space.
I'll be talking to you about it again, hopefully within the next 12 months.
That'll be great.
Fantastic.
Thanks,
Ash, thanks so much for sitting down and taking us through that. Appreciate it.
Thank you very much. Thanks for having me.
If you enjoyed that Fund in Focus, make sure to give it a like and don't forget to follow our YouTube channel because we're adding lots of great content every single week.